Okay, so Canada's economy, it's promising us this huge $3.65 trillion future by 2035. I mean, that's nearly $1 trillion in potential growth. It's a staggering number, right?
Uh-huh.
Promises jobs, prosperity, staying relevant globally. But, and this is the big but, that potential only really kicks in if we stop treating AI like, I don't know, that fancy gym membership we all buy in January. You know the one. Looks great, promises amazing results, but mostly just gathers dust in the corner of our economic garage.
Exactly. It's the ultimate conditional forecast. And the condition is clear. Rapid, proactive investment in technology now. And what makes this whole picture even stranger, almost paradoxical, is while we're dreaming about trillion-dollar AI innovation, Ottawa is still struggling with something incredibly old school, mundane even, federal office space logistics.
Yeah, seriously. We're jumping from quantum algorithms straight to, hey, do we have enough desks? Desks, cubicles. They're suddenly back in demand in the federal government. It's
Yeah.
kind of wild. The official plan, just last year, was all about slashing the federal office footprint, saving billions, embracing the future of work. But now, that whole savings plan is being walked back aggressively because apparently the government needs more people, more cubicles, more often.
It really is a study in economic contradictions. It just highlights this profound gap between the national aspiration, the big vision, and the bureaucratic reality of execution. You can see the friction, right? The inherent drag in Canadian policy and government management clashing directly with the sheer speed and scale of AI change.
Absolutely. So our mission for this deep dive is to really dig into this massive clash.
Yeah.
We've got the trillion-dollar AI potential bumping right up against this bureaucratic inertia. And then, crucially, what does that collision mean for your investment decisions? For Canadian trades right now, we're sticking specifically to the source material we've got here. This is the duality, the contradiction you absolutely need to understand if you're trading Canadian markets today.
It sends such a mixed signal to the global market, doesn't it? On one side, you've got AI screaming, innovation, trillions. It demands radical modernization, efficiency, moving fast. And on the other side, the government is effectively saying, sorry, folks, hit a bit of a snag here. The future's kind of postponed.
Huh?
Wee, I need to keep these cubicles warm, keep leasing all this expensive office space.
It really is like trying to run the most cutting-edge AI model on Windows 95 hardware. The machine's clunky, the updates are painfully slow, and efficiency, forget about it.
Okay.
Let's unpack this right away. Let's start with that huge promise, the one the PwC report dangled in front of us,
Yeah.
that $3.65 trillion future.
Right. So for context here, we're leaning heavily on this new PwC Canada report. It just came out this week, Wednesday, September 24th, 2025. And this report, it's a really comprehensive look, an explicit exploration into unlocking Canadian economic growth. It's a very existence kind of acknowledges a key failing, that Canada has frankly lagged globally. We've got world-class AI research, the foundational stuff, the talent, but we struggle to translate that into actual commercially successful market applications.
And a headline number, that's what really grabbed everyone's attention. They're forecasting Canada's GDP could hit as much as $3.65 trillion by 2035. Just to give you a sense of scale, our 2023 GDP was around $2.89 trillion, so that's a potential lift of, $760 billion? Getting close to an extra $1 trillion in economic activity over the next decade, that's huge.
It is huge. But that massive projection hangs entirely on one very big operational if. The nation has to take, and I quote, swift action to close the AI adoption gap and secure technological advancement across key sectors. This isn't just passive growth like demographics or something. This is growth we have to earn through targeted, proactive investment and, crucially, immediate integration of AI tech across industries.
Hold on, if PwC is so confident this optimistic scenario is credible, why are we only hitting 75% of the U.S. adoption pace right now? What are the big roadblocks here, beyond just tariffs, I mean?
That's where the commercialization challenge really bites. Canada, historically, we're great at the discovery part. The research labs, the university spin-offs, brilliant AI minds come here. But translating that basic science into real products, scaled up businesses, getting it widely used in industry, that takes deep, long-term capital investment and, frankly, a market structure that rewards taking big risks. The sources mention our venture capital scenes, especially for those later scale-up funding rounds. It often struggles compared to the U.S.
That makes a lot of sense. It's like we're great at inventing the engine, but we have trouble building the giant factory needed to mass produce it.
Yeah.
Okay, let's dive into those three scenarios PwC outlined. because they give a really powerful picture of what's at stake. They look at a mix of things, right? Industry adaptation, climate change, geopolitics, demographics.
Exactly. And these things are all tangled together now. It's not neat sectors anymore. Think about it. Using AI to optimize energy grids, that's climate response, right? But it directly impacts national security, which is geopolitics, and the cost of doing business, which is industry adaptation. But the key variable, the one that really decides if we hit that $3.65 trillion target, it's the level of geopolitical turmoil. Whether it calms down or ramps up directly impacts Canada's ability to adopt AI in really important areas and think mining, defense tech, supply chains, those politically sensitive sectors.
Okay, let's break down the three outcomes PwC mapped out. The best one, the most optimistic, projects a 9.3% boost over what we normally expect by 2035. This is the one that gets us to that $3.65 trillion number. So what does it take to get there? It needs a cooperative global approach for AI adoption and high levels of public trust, especially in cybersecurity and how data is managed. It's a vision where, borders are open for collaboration and people here trust the tech enough for it to spread quickly.
And importantly, PwC's leadership is actually backing this view. Noshane Rousseau, he's the national managing partner at PwC Canada, is quoted saying he's confident that the most optimistic scenario is credible. So this isn't just some pie-in-the-sky best-case dream. They seem to think the economic levers, the policies needed, they're actually feasible if, and it's a big if, they're executed decisively.
So the potential's definitely there. Execution is the question mark. Okay, then we slide down to the middle scenario. Here, the report imagines a world where maybe global efforts on climate change fall a bit short. And critically, AI adoption lags. Maybe regulations slow things down, or companies are just slow to buy in. This scenario still gives us a respectable 6.9% GDP boost over the baseline. That translates to about $3.57 trillion GDP by 2035. Still pretty good.
Yeah, the difference between optimistic and middle isn't a chasm. It's driven by, marginal differences in pace. A few percentage points slower on AI adoption, a couple more geopolitical headaches, maybe a slightly slower energy transition. But those small margins, they start to cost serious money when you're talking about a trillion-dollar economy.
And then the bottom rung, the least optimistic forecast. Here you assume geopolitical tensions really gum up the works, global collaboration breaks down, and maybe widespread mistrust slows down tech, use fears about jobs, maybe foreign interference scares regulators. In that kind of fragmented world, GDP growth is pegged at just 2.1% above baseline. That lands us at $3.41 trillion.
Now, let's look at the dollar difference there. Just focus on that. The gap between the best case, $3.65 trillion, and the worst case, $3.41 trillion. It's $250 billion. $240 billion in lost economic potential over the next decade. That $240 billion, that's the price tag. It's the financial measure of whether Canada can overcome its own internal friction and actually integrate with global tech trends.
So $240 billion is riding on our ability to embrace AI, manage geopolitics, and, basically get out of our own way. And this brings us right back to that Canadian catch, that contradiction where this lag really shows up. Despite having the research chops, our AI uptake is currently only about 75% of the U.S. adoption pace. We're just not keeping up with the main engine of global innovation.
That 25% gap, that's the core problem. And Rousseau from PwC, he pointed right back to that persistent challenge. It's the commercialization of these technologies. It's that jump from the lab bench to the actual production line to the market.
And what are the reasons they give for that specific lag? It's not just that companies don't care, right? Rousseau mentioned the overall economic conditions here in Canada, plus all the uncertainty around tariffs and trade policy. It's making some companies hesitant. They're holding back on making those really big, necessary capital investments for full-scale AI adoption. Investment uncertainty is choking off the very thing that could unlock that $760 billion in growth.
Exactly. Companies look at what's required: huge investments in new cloud infrastructure, retraining thousands of employees, massive data security overhauls. And they pause. They hesitate because the immediate return looks cloudy. Economic uncertainty, high interest rates, worries about trade wars. It all plays in. So we have the blueprint for this trillion-dollar boom, potentially, but we're hesitant to actually, break ground, mostly because of financial caution.
And this is exactly where the conversation pivots, right? From the future of trillion-dollar tech to the much more, mundane, but incredibly expensive problem of desks and offices right now. I mean, if we struggle with the basic logistics of seating 306,000 people, how on earth can we manage the massive investment required to overhaul our entire economy with AI?
It's a startling transition, isn't it? Because it just throws into sharp relief this fundamental lack of operational efficiency. Within the very system that's supposed to facilitate the economic growth we're just talking about, we jump from the cutting edge of global tech AI right down to basic seating charts for federal employees in Ottawa. This is where that bureaucratic inertia becomes a real, quantifiable, multi-billion-dollar drag on potential savings.
Yeah, well, let's look at the original plan. This was Public Services and Procurement Canada, PSPC. Last year, they had this really ambitious goal that was all over the news. Offload half 50% of its entire office portfolio by 2034. It was pitched as modernization, embracing hybrid work efficiency.
And critically, this wasn't just some vague idea. It had a massive, specific financial target baked right into the federal budget. The 2024 budget clearly stated this 50% cut would generate substantial savings. Specifically, they projected saving $3.9 billion over the next 10 years, just in operations and maintenance costs. And then another $0.9 billion per year after that decade. These were huge projected savings meant to offset other government spending. Big numbers.
And then comes the reality check. The ministerial transition binder, prepared for the new minister, Joel Lightbound, basically confirmed the plan has been, well, catastrophically undermined by recent developments.
Which sounds like classic bureaucratic speak for, oops, we didn't manage to do it.
Yes, exactly.
Yeah.
PSPC is admitting their downsizing plan is derailed. And the main reasons they're citing: it's a mix of administrative and policy changes, things like new, stricter rules about getting rid of surplus assets, just sheer growth in the number of employees needing space, and of course, the big one, the updated directive mandating more time spent in the office. And the result: a massive climb down, a huge retreat from that original 50% goal, which hits the federal books hard. The government is now projecting it will only manage to get rid of around 33% of its office space over that 10-year period. That's way down from 50%.
And that reduced target translates directly into a painful financial hit. We're talking about losing $1.45 billion in potential savings. The associate operations and maintenance savings are now only projected to be $2.45 billion over the first 10 years, down from the original $3.9 billion goal. That's $1.45 billion that now has to be spent on leasing, maintaining, operating office space the government originally planned to get rid of.
It's a huge policy failure, really. And it seems driven by these policy shifts. Let's get into the mechanics of this inertia, because that hybrid work directive seems key. Federal public servants now have to spend at least 3 days a week in the office, minimum. That's up from the older, more flexible rule of 2 or 3 days a week, which was in place before last September.
And the demand for physical presence goes up for leadership. For executives, it's even stricter. They need to be there 4 days a week. The immediate, unavoidable result of a policy shift like that: you simply cannot implement those deep space-saving measures you needed for the 50% cut. Things like hoteling or shared desks, they become much harder.
Right. The second you demand 3 or 4 days in the office, the ratio of desks to employees you need just skyrockets. You need the physical space to handle a much bigger chunk of the workforce being there at the same time. But it wasn't just the rules that changed, was it? The actual number of public servants grew too.
That's the dual whammy. Michelle LaRose, the PSPC spokesperson, confirmed this. She said their original math for the 50% cut was based on roughly 290,000 full-time employees. But the updated analysis, they had to deal with a significantly bigger number: 306,000 full-time employees.
Wow, that's a big jump. 16,000 new employees needing desks, chairs, office space. LaRose explicitly said, quote, "This updated analysis confirmed that changes in hybrid work policies and public service growth directly impact the amount of office space required." So the decision to force more in office time, plus the growth in staff numbers, basically locked them into keeping a huge real estate footprint.
And that's why hitting that original 50% reduction target is now, functionally, impossible in the planned timeframe. But let's ask the critical question the sources kind of dance around. Is it really just employee growth and new mandates that caused a $1.45 billion policy failure? Or is this maybe just bureaucratic cover for a failure to execute that was already happening?
That's the core critique, isn't it? This story of government being slow. It's not new. It seems systemic. Remember the Auditor General Karen Hogan? Her report back in June pointed out the federal government has been consistently slow on reducing office space, even though they had plans to downsize going all the way back to 2019. So the inertia was already there. Maybe the new work rules just gave them an excuse.
It's definitely not just an administrative issue. It feels political, too. That push for 3 or 4 days in the office, likely driven by political pressure? Maybe ministers worried about remote productivity, or maybe even union pressure demanding dedicated physical desks. But that policy choice mandating physical presence came with a hefty price tag: $1.45 billion over the next decade.
So just to recap, we have a country that could add almost $1 trillion to its economy by adopting AI faster. But economic conditions and this commercialization lag are slowing things down. And at the exact same time, the bureaucracy is failing to save $1.45 billion in guaranteed office costs because it can't even execute a downsizing plan that's been on the books for years. The government's inability to deliver on a predictable $1.45 billion cost-saving plan, that screams unpredictability. And that unpredictability is absolute poison for commercial real estate assets.
That's the Canadian duality in a nutshell right now.
Yeah.
Huge promise, shaky execution.
Okay, so this duality, the AI boom potential versus the office bust reality, this is a critical signal for anyone in the market, domestically, internationally. It tells you where capital might flow and where it might get stuck. Let's translate these contradictions into some concrete investment ideas, starting with the upside, that potential AI acceleration.
All right. If Canada does start seriously closing that AI adoption gap, moving from 75% of the U.S. pace towards something closer to parity, then you absolutely need to watch Canadian tech and AI-adjacent stocks very closely, particularly the ones set to benefit from the kind of mandatory corporate overhaul that AI requires. The opportunity is exactly where that necessary investment for commercialization is going to land.
So we're talking about companies in areas like software, data security, cloud services. These are the building blocks, right? The foundational infrastructure needed for widespread AI integration across big Canadian sectors, resources, defense, finance. These are pillars of our economy. If Rousseau's confidence is right, and that optimistic scenario is credible, these areas could see significant gains from focused corporate spending that's maybe been held back until now.
Yes, and I'd look beyond just the pure play AI firms too. We need to identify the Canadian companies that provide the security infrastructure, especially for regulated industries like banks, to adopt AI safely. Financial services firms, for example, they can't just plug in large language models without rock-solid guarantees on data sovereignty and cybersecurity. That's where major Canadian spending is almost inevitable. So that creates opportunities in security and cloud infrastructure specifically.
Okay, conversely, the office bust story gives us a really clear warning sign for a specific asset class. Real estate investment trust reachers, especially those with heavy exposure to commercial office space, particularly in cities with big public sector footprints, like Ottawa. You need to tread carefully there.
Absolutely. The problem isn't just potentially slow demand, it's the policy risk, and that is almost impossible to accurately model. The federal government's policy flip-flop going from a 50% downsizing goal down to maybe 33%, all within about a year. It just shows profound instability in commercial office demand. It's politically driven, it's highly volatile, completely unpredictable. And that unpredictability directly hammers long-term lease valuations.
That volatility is the market risk. 1 minute, the government is your anchor tenant, stable, embracing remote work savings. The next minute, a new directive comes down mandating 3 or 4 days in the office, and boom, the whole supply-demand picture shifts dramatically. These policy U-turns inject massive instability into a sector that needs predictable cash flow and tenancy rates. So a high concentration of federal leases in a REIT portfolio, maybe that should be viewed more as a risk factor now, not a safety net?
The implication for those REITs is clear. Their models, the ones forecasting vacancy rates and renewal terms, they're being undermined by politics and bureaucracy. The fact that the federal government, Ottawa's single largest tenant, can't even execute its own planned cuts effectively. That signals significant volatility and uncertainty for commercial office demand in major Canadian cities for the foreseeable future. It probably justifies a discount on that whole asset class.
Okay, switching gears slightly, let's glance at the U.S. market context. Because our AI adoption rate is measured against the U.S. pace, and the U.S. seems to be signaling some massive investment priorities, especially in critical infrastructure.
Yeah, U.S. stocks, as of this week, they're kind of drifting a bit, taking a breather after that big rally pushed the S&P 500, the Dow, the NASDAQ all near their all-time highs earlier in the week. The market seems to have been running on basically two key hopes.
Which are, first, that President Trump's potential tariffs, the ones everyone talks about, won't completely blow up global trade, and second, that the Federal Reserve will deliver multiple interest rate cuts to kind of ensure a soft landing for the economy and boost corporate profits.
But here's the caution flag for global investors. That big rally has raised real concerns that maybe stock prices shot up too fast. Maybe they become fundamentally too expensive, especially if the Fed doesn't actually deliver as many rate cuts as traders are currently pricing in. So it's a market built on optimism about future rate relief and low trade friction, both of which are, highly conditional, not guaranteed.
Now, connecting back to our AI theme, there was a really dramatic signal just today in the energy infrastructure space, and it speaks directly to government priorities. Let's talk about Lithium Americas. Their stock soared. What was it, 87.6% after reports of potential U.S. government backing?
This surge is absolutely fascinating because it directly links the need for raw materials for the whole AI infrastructure transition. Think batteries for EVs, massive power backups for data centers with significant state-level government involvement. Lithium Americas, even though it's based in Vancouver, Canada, is in deep talks with the U.S. Department of Energy, the DOE, and also General Motors, GM.
And they're talking about drawing on that huge, previously announced $2.26 billion loan from the U.S. government. Lithium Americas mentioned the Energy Department's making these incremental requests, asking for more conditions before they can actually draw the first bit of cash. That suggests the U.S. government isn't just handing over money. They're getting keenly involved, shaping the terms, maybe even the company's operational strategy.
I'm really fascinated by this Lithium Americas situation. Does this signal a sort of new era where governments become active, necessary shareholders in the AI supply chain? A bit like that Intel stake. It definitely connects to a broader industrial policy trend we're seeing. We saw the precedent set earlier, right? Under the Trump administration, the U.S. government took that significant 10% ownership stake in Intel, the struggling chip company. Why? To ensure domestic chip production.
Right, that 10% stake in Intel wasn't just typical government aid. It was a clear signal. When infrastructure, whether it's computer chips or lithium for EV batteries and AI power grids, when it's deemed critical to national tech goals, governments are willing to step in, become active shareholders to secure that supply chain.
So the trading implication here seems pretty clear. Government backing, especially for critical inputs like lithium that feed that high-tech supply chain, can trigger massive, immediate stock surges. Even if the company itself is Canadian-based, like Lithium Americas, it's the infrastructure needed for the AI future that's getting the political and financial spotlight.
Yeah, the lesson seems to be, if you want to spot the next potential big gain, maybe follow the policy priorities. Where are governments focusing on securing the AI supply chain? Because they seem willing to open the public purse and even take an ownership stake to make it happen.
Now, we absolutely have to circle back to that central caveat in the PwC report. Remember, the most optimistic AI growth scenario, that $3.65 trillion future, it hinges on geopolitical stability, on global cooperation. The degree to which geopolitical turmoil ramps up or calms down is a critical factor. It directly impacts Canada's AI adoption rates and the ability of our companies to commercialize globally without running into trade walls.
And we have a perfect example of highly unstable geopolitical turmoil playing out right now at the UN. It shows just how fragile that global cooperation can be. This whole issue with Iran and the looming snapback sanctions. It could really fragment global energy markets, trade.
Indeed. Iranian President Masoud Pezeshkian was at the UN podium on Wednesday. He gave a very critical speech blasting U.S. and Israeli attacks from back in June, called them a grievous blow upon international trust and the prospects for peace. His rhetoric is pretty much the opposite of the global collaboration PwC says we need.
He also repeated Tehran's position that they aren't pursuing nuclear weapons, declared Iran has never and will never seek to build a nuclear bomb, clearly aimed at trying to head off the severe diplomatic action that's already underway.
But the huge issue hanging over his entire address is the fact that a series of crippling UN sanctions are looming right over Tehran. This is because of the snapback mechanism. It's being triggered by the E3, that's Britain, Germany, and France, because they say Iran failed to comply with the 2015 nuclear deal conditions, the JCPOA.
Okay, for listeners who might not follow the twists and turns of the JCPOA, maybe explain snapback. What does that actually mean?
Sure. The snapback mechanism, it's a really powerful tool built into the original 2015 deal. It lets any of the original signatories, in this case the E3, basically trigger the automatic immediate reinstatement of all the old UN sanctions against Iran. And crucially, it doesn't need a new UN Security Council vote. It bypasses potential vetoes from countries like Russia or China. The E3 triggered it because of Iran's escalating uranium enrichment activities, which they argue is a clear breach of the deal.
That's a critical point. It means the sanctions are almost guaranteed to come back into force. The 30-day window to stop them through negotiation, it ends this coming Sunday. Pezeshkian predictably slammed the E3's actions, said they acted in bad faith, trying to dictate compliance with the deal the U.S. walked away from unilaterally back in 2018.
The fundamental problem, though, for the global market is that a diplomatic off-ramp seems highly unlikely right now. Pezeshkian's efforts at the UN were seriously undercut when Iran's supreme leader, Ali Khamenei, explicitly rejected any direct nuclear talks with the U.S. just days earlier. That almost certainly signals the snapback mechanism will take full effect, which means the renewed isolation of a major global oil producer.
And we're already seeing the impact, right? The immediate severe economic instability inside Iran. That's the most tangible financial proof of this geopolitical friction. Just before Pezeshkian spoke at the UN, the Iranian currency, the rial, hit a new all-time low. It was 1,074,000 to the US dollar.
Yeah, that kind of currency collapse, it reflects intense fear about imminent economic isolation, about the sanctions hitting hard. It's a direct market reaction to the failure of global collaboration. And it's a stark illustration of why PwC listed severe geopolitical tension as a factor that could push Canada down into its least optimistic scenario, potentially costing us that $240 billion in economic potential. Global instability just drains confidence, it inhibits collaboration, and it slows down the investment needed for tech commercialization.
It really is the difference between a globalized cooperative AI boom that unlocks $3.65 trillion and a fragmented, mistrustful tech stagnation that leaves Canada lagging behind. The macro environment, the geopolitics, it's directly dictating the micro investment choices happening in Toronto and Vancouver right now. #tag outro.
So wrapping up this deep dive, the core contradiction for you, the listener, it remains pretty stark. Canada clearly has the brain power, the talent, the research for that $3.65 trillion AI future. But we might still be stuck fighting over which public servant sits in which office chair as Ottawa and wasting billions in the process. Yeah, for traders, that duality is both things, isn't it? It's a warning, definitely tread carefully around commercial real estate exposed to those unpredictable federal policy swings, but it's also a massive potential opportunity to invest in the Canadian infrastructure needed for AI commercialization if and when Canada finally closes that adoption gap. If we take that swift action, PwC recommends.
And here's where it gets really interesting. Our final provocative thought for you to chew on. What's the ultimate, maybe unstated cost of Canada's commercialization lag? If the same bureaucracy needed to manage 306,000 public servants in physical offices is simultaneously inhibiting the private sector investment needed to reach that $3.65 trillion AI future, are we basically sacrificing a massive economic destiny, the chance to add nearly $1 trillion to our economy just to maintain the status quo, just to keep the cubicle culture and organizational friction going?
It's a stark contrast. The office bust is a direct, quantifiable drain on taxpayer savings right now. The AI lag is a potential massive drag on future national prosperity. Where should the priority be? What's the right economic focus? We'll leave that question with you.
And as always, the mandatory disclaimer. This deep dive is strictly for educational and entertainment purposes. None of this is financial advice, and it's not intended as such. Please do your own thorough research, or better yet, consult a licensed financial advisor before making any trades or investment decisions.